Hello everyone, welcome to my YouTube channel. André Cardoso here. Thank you very much for being here. As always, it's a pleasure for me to share my views with you. You can also find some of my work on those websites and those partners, specifically the FX Street community, the TradeGate Hub, recently interviewed by Dale Pinkert. Most of you already know him from Face project and Forex Analytix. Of course, Forex Analytix, which has merged communities with Forex Flow. So for that being said, let me share with you some of my work here on my YouTube page. And let's start with the Dixie on a weekly time frame. Actually, we can go into a lower time frame. Let's see a daily time frame for the Dixie. So as some of you already know, and some of you are already familiar with my work, I tend to search for those advanced pattern formations, those harmonic patterns, and I try to create a risk strategy to trade them once the price completes those patterns. So that's not the case for now. We are far away from the completion of this bearish crab pattern projected at 98.14, but at the same time we are facing this trend line resistance. So there is a trend line resistance for this shining channel. Some of you may be already familiar with this one. So I believe there's a chance for, or let's say there's a probability for the price to start to feel some pressure. This is previous structure support level. This is also the 200% Fibonacci extension level, which is the default target for the technical double bottom printed below. So, and this is also the 50% Fibonacci retracement from all these highs to the bottom. So a retracement from all this swing low to the 50% Fibonacci retracement level. The level that I want to pay attention is at 98.14, as I said before, because we have a very nice cluster between golden Fibonacci retracement level, the 61.8, and the golden Fibonacci extension level, the 161.8% Fibonacci extension of the very last swing low projected above. So that being said, I will pay attention to this price zone if the price decides to approach that zone or those Fibonacci levels, but without ignoring the possibility for, even if limited, the possibility for a retracement from this trend line, or for those from these elements of pressure, the 50% Fibonacci retracement level, the default target for the heads and shoulders, which usually offers some pressure. Even, as I said, even if limited, the price may feel some pressure right there. And we have also the descending trend line resistance, which may offer some pressure, though all those elements may offer, let's say, a retracement or a pullback for the Dixie. The same way we expect that retracement for the Dixie, or let's say I do expect that pullback, as I said, even if limited. We may expect the same to happen on the euro versus dollar, which has already achieved the default target for the technical double top. I also shared this chart multiple times during the previous weeks, expecting as soon the price breaks below the next zone of the support, which was the monthly fractal, by the way, monthly fractal support right there. Once I saw a violation of this support level and the reinforcement and the rejection of this support level, which did trigger the trade. So we went short after a retest and after the rejection of the previous structure support level, expecting the price to achieve the 200% Fibonacci extension level. This one converging with the golden Fibonacci retracement, the 61.8. As you can see, the Dixie is trading the 50% Fibonacci retracement level, while euro versus dollar is already trading the golden Fibonacci level. So that being said, the same way I'm waiting for the bearish scrap pattern to be formed on the Dixie, we can wait for the formation of this bullish shark pattern, or this bullish crab pattern, I'm sorry, at 111.38 for euro versus dollar. It's a very, it's exactly the same pattern, inverted correlation with the Dixie. So I prefer to wait for the price to achieve those levels in order to decide if I want to get any type of involvement with euro versus dollar. Until there, I prefer to stay away. Of course, if you draw parallel descending channel between covering those highs, you can also project this as kind of a parallel descending channel, or kind of where we are already threatening the bottom of that structure, or the trend line support of this descending channel. So that being said, I will not be surprised to see very similar and inverted correlated with the Dixie, a bounce from this price zone based on those elements: the golden fib, the 200% Fibonacci extension, and eventual the trend line support for this descending channel. I will not be surprised to see that happening for both the Dixie and the euro versus dollar. Now, the Australian dollar, we have a few. I have a few patterns. We had a few patterns projected above, kind of inverted, actually, an edging shoulders right there. But that's not the pattern that I want to share with you. In fact, I'm sorry, we have no clear pattern for the Australian dollar except this bearish flag. So we are now trading below the 200 daily moving average. We are also facing, I believe this is kind of a 50% Fibonacci level, right there, 50% Fibonacci level, the weekly fractal. So we're still trading inside this flag pattern formation, and I do believe that a violation below this trendline support, and we can see this as an ascending trend line support, or you can wait for a violation of those major support levels. The violation of the support may offer or may trigger more downside momentum for the Australian dollar. Of course, and because we are trading and because we are approaching an ascending trend line support, and because Dixie is also trading those elements of pressure as eventual resistance, the euro versus dollar also approaching a potential element of support level, we should not ignore the potential for another bounce, and eventually we will force it to extend this channel or this flag into another swing high, let's say a 5-wave structure inside this flag formation. So let's say another bounce from this price zone will not be a surprise, but ultimately I want to see a violation of the support, which should trigger a downside momentum, and eventually I will search for the formation of another shark pattern which can extend to 66.96, let's say 66.90, between the golden Fibonacci and the 224% Fibonacci extension level. So basically the pattern that I want to see Aussie forming after this consolidation period, it's something like, let me try to draw this, it's something like this. I want to see the shark pattern being forced to trade a few points below the support, the golden Fibonacci level. This may offer a retest of the previous support level. So if the price starts to bounce from the golden Fib, that may offer a retest of the monthly, weekly fractal support, and eventually even a major bounce from this price zone. But and the 224% Fibonacci extension projected a few points below, which may also offer nice pressure for Australian dollar. We can also project kind of an ABCD pattern, and that one being projected at the 224, or a few points below the 224% Fibonacci extension level, which means we have some convergence between a symmetrical ABCD pattern and one eventual bullish shark pattern, this one projected at 224% Fibonacci extension level. So that being said, let me tag the 66.93 for the Australian dollar. Ultimately will be forced to trade even lower, and if that happens, I will pay attention to that price zone. 4 hours time frame chart, dollar versus the Japanese yen. After multiple patterns, I identified, well, let's say we were capable to identify this potential inverted edge and shoulder. This is not one of the patterns that usually we try to identify as a continuation. Usually we search for those events as a reversal behavior. But we can also try to identify these sequences as a reversal after a descending correction. What that means is we have a nice bullish swing, and then the price starts to move sideways inside a correction, which can have different degrees. In this case, we have this descending channel, this parallel structure, and as soon the price breaks above the flag formation, so let's call this a bullish flag formation, as soon the price violates the resistance of this structure, we saw the validation not only of the pattern, so we saw the violation not only of the structure, but we saw the validation of the inverted edge and shoulder. So by default, as I show you multiple times, the hedging shoulders will target the 200% Fibonacci extension level. So which means we need to see dollar versus the Japanese yen squeezing into the 115.58. So this is just a few points above the current price zone. Not just a few, actually this is a 4 hours time frame. It represents nothing more than 60 points above the most recent highs for the Japanese yen. So if you like to trade symmetrical patterns, we can also try to use this projection as a symmetry, and as you can see, that will put a symmetrical pattern will put the price trading very close to that golden Fibonacci extension and the 200% Fibonacci extension level. So let me decrease my time frame into a 2 hours time frame, and let me show you also another possibility for dollar versus the Japanese yen, which implies again more bullish momentum. And the reason I'm saying this is because I want to see the golden Fibonacci extension being reached. So that being said, I want to see something like this being formed, kind of a bearish sharp pattern at the golden Fibonacci extension level. So that converges with the 200% Fibonacci extension level, which is a default target for the inverted edge and shoulders. But because we are trading an inverted edge and shoulders after a very strong bullish momentum, and not as a reversal or as a major reversal event, it can fail to achieve those default projections. But even though we have a nice setup there and a nice violation of this bullish flag formation as projected multiple times also, so we expect some more bullish momentum for dollar versus the Japanese yen. Now, the same way we may expect some more bullish momentum for the dollar versus the Japanese yen, which is the leader when we talk about the Japanese yen pairs or the Japanese yen crosses. Multiple patterns right there, as I published before, and I shared some of them with you on YouTube or on Twitter, I believe. We have this bearish butterfly pattern printed on a higher time frame. I was expecting at least a 38% Fibonacci retracement to be reached after the formation of this butterfly pattern. As we can see, the price has found resistance a few points above the completion point and then starts to print this correction. And I was expecting at least a 38% Fibonacci level to be reached, which is, by the way, it's not usual to see a butterfly pattern. Once it starts to work for us, it's not usual to see the price or the pattern failing to achieve those default targets, but sometimes it will happen, and that's the case. The very first Fibonacci level being used as support at 23% Fibonacci level, monthly fractal support already at 148.45, and then the formation of a bearish shark pattern, as I shared multiple times also with you on Twitter, forcing the price to fall again. I shared this one as a bullish or a potential bullish alt bat pattern at 113% Fibonacci extension. It's not the price zone, or it's not the usual or the most common price zone to try to identify the alt bat pattern. But well, I always project that pattern. I call those internal, let's say, internal behaviors, which means instead of searching for a major alt bat pattern, covering all that range, instead of searching for this swing, I can try to identify an internal pattern inside this range, and I can try to play inside this range multiple patterns. So that being said, I was not expecting a deeper pullback for the pair. Once I start to see the price approaching this golden Fibonacci 61.8% Fibonacci level, converging with one eventual minor and internal bullish bat pattern, I projected this as one eventual opportunity to go long from the 113% Fibonacci extension. By default, that pattern will search for the 38% Fibonacci retracement level. As we can see, we are already trading that Fibonacci retracement level, which means the price may find some pressure at this price zone, but as we can see, we're still trading inside one potential and eventual bullish momentum, as you can see, indicated by the 200 moving average, which is also pointing for more upside, or which may also suggest more upside momentum. If that happens, and that will depend, I don't know what will happen from here. We have also a trendline resistance approaching from above. Let me cover those highs. We can draw it like something like this. So we are at this point, we are threatening a trendline resistance covering the most recent highs, as we can see. So we are threatening this price structure, but let's not ignore those markers between the previous structure highs, or the higher highs, and the next higher lows. Okay, so those higher lows may act as nice markers for a trendline resistance or an eventual trendline resistance. Let me just try to adjust this one, something like this, which may suggest also the formation of kind of an expanding triangle, or kind of also a wedge, a descending wedge. So that being said, 1, 2, 3, 4, and eventually a fifth wave then later. But as I said, this is pure speculation. I don't know what will happen. It doesn't worth a penny to start to make those projections. It makes no sense. We may see a retest of the highs, of the previous structure highs, and if that happens, we may see the formation of this cup and handle formation, or this cup formation, which requires the price to form the handle later. So let's say a retest of the weekly fractal and a pullback may offer later the formation of this, or it may trigger later with the violation of the weekly fractal, it may trigger a cup and handle formation, but we are very, very far away from that possibility. So that being said, we need to see, first of all, we need to see the price breaking again the major fractal, which it was formed last in May. Okay, exactly in May, from this here, and we assume that a clear violation of this monthly fractal resistance again may force more upside momentum for the pound versus the Japanese yen. But as I said, I can project multiple patterns above, I can project multiple patterns below. I need to see the pattern being formed. I need to see the price approaching that price zone. And at this point, I have no clear evidence where the market goes, except the formation of this bullish outpath pattern, which may offer that bounce. But we are already, if you think getting involved at this price zone, I will not suggest that, because the price already moved as expected, already trading the default target or the first target zone. We have a second target zone at the golden Fibonacci retracement level 155.99, but from this price zone, I will not I will not take the risk to try to get involved from this price zone. As I said, I prefer to wait for the formation of the pattern, which allows me to identify my targets, to identify my limits, and try to play the pattern. From this price zone, I don't suggest any type of involvement. Well, at least for the long side, at least for longs, I will not suggest. If you want to go short from this price zone, it may work for you. We are trading the 38% fee, the previous structural lows, the 200 moving average. That may offer another swing or another pullback. As I said multiple times, even if limited, you can always try to manage a trade like that, and expecting new lower lows eventually from this 200 moving average. But I don't have a clear, we have a price structure, the previous structure support, now potential resistance. We have the Fibonacci level, we have an element as a moving average, as a potential element of resistance, but only that. I don't have a specific pattern. I don't have a specific price move where I can say, okay, the price repeats this process over and over and over again. I want to try to get involved on that process again. This is not one of the cases. We know the price usually, once the price forms support, the price usually ends up, or let's say if the price breaks a support, usually it will be forced to retest the support zone again, and eventually it will start to drop again and to fall again. We can see that kind of a behavior in a trend where the market prints higher highs, and when it starts to pull back, it will retest the previous structure highs, and then it will find support, print new highs. You know, it's the basic price, the price reaction or the price move, where the price finds resistance, then it breaks the resistance, and then it retests the previous structure resistance, and it forms a support, eventually new higher highs, pull back to the previous resistance, forms support, and always the same. No, the price tends to, in the bullish trend, the price tends to form resistance, pull back, form resistance, pull back to the previous resistance, forming support, always the same. So that being said, I will not be surprised to see, of course, the previous structure support acting as resistance with those multiple elements of eventual resistance, and eventually the price starting to fall or starting to drop from here. But what I want to see is one approach to the previous structure highs, and if that happens, I will see we may see the formation of that cup and handle. Of course, if you miss the opportunity to go long, again, from this previous structure resistance. Previous structure resistance turned into support. So that being said, this is a potential zone for the long side of this trade. Of course, as I said, I will not be surprised to see this price zone acting as a resistance now and forcing the price to start to fall. But the price behavior that I want to see is a retest of the highs and then the price starting to drop and to fall, forming the handle. And if that happens, and of course this is pure speculation, please ignore the next projections that I will show you, but the formation of this cup and handle this cup and handle may offer you a very nice sequence to trade above the resistance. And that being said, I will just try to project the default targets for that pattern just to show you the potential reward for that sequence. And I will project this exactly from the weekly fractal. So that represents nothing more than 3.5 or 3.6% above the weekly fractal resistance. Of course, we only trade this sequence after the formation of the handle and after the violation of the resistance. And usually the same thing that happens here when the price breaks the previous structure resistance and then forms support. So previous structure resistance, now support, previous structure resistance, support later. So as soon the price violates the resistance, we need to see the price retesting the previous structure highs as a resistance, turn it into a support, and then we expect a rally. Of course, the retest of this weekly fractal resistance may be formed like this, where the price enters or penetrates again this range or below the weekly fractal, it trades below the weekly fractal and then starts to bounce again. So we need to wait for that sequence. We need to wait for the violation of the fractal. We need to see the price starting to fall at some point, and this can happen from a few points immediately above the fractal. It can happen from a few points above the fractal. Of course, if the price decides to rally immediately, eventually you'll miss the opportunity to trade it. But we want to see a retest of the resistance, and after the retest of the resistance, the price should break above the previous structure highs. And as soon the price breaks above this resistance formed above the weekly fractal, we have a trigger for the long side of this sequence. Okay, I will repeat this process because it can be confusing for some of you, at least for those who are learning process. The cup and handle formation, it will only validate as soon the price finds resistance above the major resistance above the cup. The price needs to retest the weekly fractal and reject the fractal. And as soon the price breaks the previous structure highs, that should trigger the pattern. So we always need to wait for a retest of the next zone, or let's say the retest of the cup, and we need to wait for the breakout above that resistance formed before that retest. Okay, we need to wait for this. Only that, but the breakout above that resistance will confirm with a higher probability event the cup and handle formation. So we need to wait for that to happen. Okay, do not try to trigger the pattern as soon you see the price breaking the resistance, because the price can find resistance, a false breakout above, and starts to sink again, and you don't know what will happen. Even if you have, let's say, a cup formed right there, the price breaking above the resistance, which may trigger your brain, and then the price starts to fall again. So we don't want to see this. We want to see the price breaking the resistance, retesting the resistance again, and when I see a violation of the most recent, let's call this the most recent resistance price zone, we want to trade above that level. And that resistance may be printed a few points above the fractal, it may be printed a few points, or it can extend a few points above the resistance. Of course, we want to see that type of reaction just a few points above the major fractal, and we want to see the breakout of this resistance just a couple of points, or let's say we want to see that kind of a behavior right above, formed right above the weekly fractal, and that should trigger the pattern. But as I said before, and I'm losing a lot of time in this sequence without even approaching this price zone. So as I said before, this is pure speculation, but I hope that acts as some educational content for some of you at least. So previous structure resistance, previous structure support now as eventual resistance. We should not get surprised with that, but I want to see the potential cap and handle formation for the Japanese yen, the pound versus the Japanese yen. And of course, that should be followed by more bullish momentum also for the dollar versus the Japanese yen. Now, let's finish with some of the commodities and some of the cryptocurrencies. Gold, let me increase this time frame into a daily time frame. So I'm a bullish both on gold and silver. For very different reasons. One of them, the technical double bottom printed on a daily. The bullish 2618 printed at the golden Fibonacci retracement level. And of course, the major breakout of this descending structure. So basically, gold has found a way to break out above this structure, and has found also actually the market has found some support already above the weekly fractal. If you go into a lower time frame, let me just check this. We have also the most recent fractal support at these lows, and we have of course resistance at the previous structure or the most recent structure highs. So that being said, we are trading. Gold has found a way to consolidate above the weekly fractal resistance, and also above this. And well, this will depend, because the market can print us what we can call an outside return, where the price will print, in this case, resistance outside this channel or outside this structure, and then it recovers inside the structure again. I'm not expecting that to happen. I want to see gold and silver to hold above this major resistance, but we still have the monthly fractal at 1916 to break. So we need to break above this major resistance, the previous structure highs, and that should trigger another swing high for gold. Another reason to try to get an involvement for the long side on gold is of course the heads and shoulders printed here. So, and basically we are trading above the next zone. So let's say this consolidation above the major resistance it's nothing more than a retest, kind of a retest of the next zone. So we are consolidating above the resistance, above the next zone. So that being said, we should not ignore more upside momentum for gold, and I will not go much further on this chart. If you want to get more informations about the metals, you need to subscribe or to Forex Analytics, or you can subscribe to my Telegram channel, where I will share some of those charts with you and some of those patterns also. The same will happen for the for silver. Heads and shoulders formation, we have targets at 2808, but we are not trading above the major trendline structure resistance for silver. That being said, we need to wait for the breakout of this structure, but I assume that a trigger of these inverted heads and shoulders will force the price to trade higher, which implies, of course, the breakout of this recent descending channel on silver. That being said, I do expect more bullish momentum for both for gold and silver. That doesn't mean I'm waiting to see the Dixie starting to fall or to drop from this price, and I have already justified I already shared with you multiple reasons for that to happen, for the Dixie to start to fall. Of course, that's a strong move on the Dixie may offer also a move at the opposite direction on gold and silver, but sometimes they will trade momentaneously in the same direction. Last week we have both the Dixie and gold squeezing high at the same time, exactly at the same time. Actually, both of them, after some news events, with a very few minutes in difference, they started to squeeze higher, both in the same time. The Dixie and dollar index and the gold, and actually in silver being followed. That being said, I will not be surprised to see that happens again. Eventually, Dixie starts to print a new higher highs, and the dollar and the gold trying to keep his pace inside this ascending channel. But as I said, I prefer to ignore all those external reactions, and I prefer to stay focused on the technical side of those trades, and for that, and to get some type of involvement, I need to see a clear pattern, let's say a clear pattern to trade. So that being said, let's move forward into some of the commodities, also for the crude oil, and let me try to share with you my view on this one. I'm a long-term bullish. I was a long-term bullish for crude oil, of course, after multiple patterns printed right here, right at the bottom. As I shared this one, I shared multiple patterns here with you before. This one was the 113, 127. And I believe we have also golden Fibonacci here, if I'm not wrong. 161, few points above. And the 127, 113. I think it was the 113. I published this one, this Altbat pattern for crude oil at 113. And before projecting this one, I projected also a potential crab pattern, or let's say an eventual crab pattern at 161.8 extension. So at some point we expected a reaction for the long side for crude oil, and specifically after the formation of this this bullish alt-bat pattern at 113, we started to project some bullish momentum for crude oil. Of course, we don't know if the price will print a huge reaction. When we trade a specific pattern, we trade for a specific target zone. We don't expect a huge rally after the formation, or just because that pattern was formed, we don't expect this type of reaction. But it ends up being one of the patterns, one of the bullish patterns printed at the bottom of the crude oil structure, the price structure. Now, we can see this as an ascending wedge, and usually an ascending wedge, I like to see them being formed with 5 waves inside that wedge. We can see this as an expanding triangle, whatever you want to call it. I call it kind of a expanding triangle, but we can try to. I always try to identify. I ignore the name of those sequences, but once I start to see this kind of a megaphone formation, I always want to see a sequence of 5 waves structure inside this range. So of course, I don't know if that will happen. We can see crude oil starting to bounce without breaking, without recovering the major resistance, the previous structure highs. It can happen when the market can start to trade higher from this price zone. We have shorts after when I start to see the price rejecting this kind of a megaphone formation. I shared one potential opportunity to go short with the crude oil. Well, and that being said, we have targets at 74.45, and that pattern, it's basically a technical it's basically a technical double top between these previous structure highs and lows and the retest then later. So basically a violation of the support should trigger the pattern right there, but I'm trying to short we tried to short the retest, or let's say the reinforcement, better saying. We tried to short the reinforcement of this trendline resistance. So I want to try to go and to form this ascending wedge, or this expanding triangle. I want to see if crude oil will be forced or not to reinforce this trendline support again. If that happens, it will be a fine trade. It will be a nice trade to cover once the price approaches this trendline support again. Of course, we don't know if that will happen, but the risk reward based on the structure, it did offer a nice event and a nice attempt to try to go short. Now, Bitcoin and Ethereum, just to finish my video for today, my presentation for today with you. I shared multiple times this one for Bitcoin, the eventual BAT pattern. This one also 113% Fibonacci extension level. We saw the price approaching these completion points multiple times, and it did not form the sequence as we expected, or at least as we expected, 113% Fibonacci extension, but it starts to fall after the breakout of this trendline support. So we have kind of a ascending channel, or ascending wedge right there, and the violation of this support level, forcing the price to fall. So basically, I want to see we need to see a violation of the previous structure low, 56,469. So let's say 56,500. A clear violation of these levels may force Bitcoin to trade even lower. So if we remove this pattern from here, we can see this also as a potential 3-wave structure formation, or let's say kind of a symmetrical pattern being formed. And if I need a default target for that pattern, I always point to the 38% Fibonacci retracement level. So 53, this is the price zone where I can see, where I may see the Bitcoin trying to find some support level. Of course, nothing is granted. I don't have a specific pattern for Bitcoin at this price zone. What I know is if the price trades the golden Fibonacci again, this will print me a bullish shark pattern for the long side. So 48,762. This is the 50% Fibonacci retracement level. That is nice. That's perfect convergence between the golden Fibonacci extension and the 50% Fibonacci retracement level. If the price decides to approach these levels, that will complete the bullish shark pattern, which may offer a bounce from this price. And as I said, I don't know what will happen from here. We don't have a specific pattern, but the formation of this symmetry always implies, or let's say always suggests, at least a retracement back to the 38% Fibonacci retracement level. Let's pay attention also, we are also facing the very first Fibonacci retracement level, the 23% Fibonacci right there, which is offering support for Bitcoin for now. But let's say tune it to the possibility to form that shark pattern at 48,762 on Bitcoin. Ethereum, the very similar reaction expected. This was projected as a bearish butterfly pattern. Note that both the Bitcoin and Ethereum, they both can print that pattern for us, and if the price decides to bounce from this price zone and prints new higher highs, it will complete that sequence. It will touch, the price will at some point touch that Fibonacci level. So, and as I said, nothing is granted. We don't know what will happen from there. We know that after the pattern being formed, we know that usually, let's say, the probability for a pullback will start to increase, and the pullback to the 38% Fibonacci retracement level offers you one specific amount of reward. And that reward, and let me just use this as a projection. So this is kind of 25% drop on Bitcoin after forming the pattern. So if you take this reward as your guideline, let's say, as your guide element. So if you are trading for 25% in a specific instrument, which is not usual unless you are trading the crypto markets, but if you are trading for if you are expecting a 25% drop on Ethereum after completing the pattern, it doesn't make sense to use kind of, let's say, 40% as your risk. One of the rules that I created for myself, and I believe some of you share the same rule, I never enter the market to lose more than what I expect to win. So I'm expecting the price to start to fall from the 50-90. So I want to short the market right there for 25 points. But let's say if the market starts to trade against me, I will protect my position at 40 points. What the hell? If I repeat that process over and over again, in 10 trades, I will burn my account. Or 20 trades, I will burn my account. If you start trading 1% of your capital for each single position or each single trade, you start trading with 100 trades to trade. So you have 100 trades to burn your account. If you think it's possible to burn your account losing 100 consecutive trades, you are very wrong. It's not possible. If you are a good trader, if you are a decent trader, you don't need even to be a good trader. If you are a decent trader, you will not share those performances. You don't get those performances if you apply a decent risk strategy to trade. You never lose 100 trades in a row. Okay, you don't lose 100 trades in a row, and you don't need, because probably after losing 20 trades in a row, you can't trade anymore. You need to stop trading and do something else, because it's not your thing, you know. You need to start to think about other process to develop. But if you want, let's say you have $10,000 to start to trade. If you put 1% at risk for every single trade you push, that means you start to trade with a risk of ruin of 100 trades. Okay, 100 trades, putting 1% of risk, of course, that will burn 100% of your capital. Of course, if you increase the percentage of risk in one single trade to 2%, or 3 or to 4%, that will decrease the amount of trades that you have left in order of in terms of risk of ruin. So you need to lose, let's say, 50 trades in a row, and you will burn your account. I honestly, if you are a decent trader and disciplined person in your trading career, that will not happen if you have a decent risk reward. So that being said, and just to complete this idea, if I enter the market to expecting to trade for 25%, and if I use a 50% range as my limit, if I repeat that process over and over and over again, I will lose my account very, very fast. So what I always suggest is to identify your default target zone. So if you are trading for 25%, you don't want to lose more than those 25% loss. So let's say it's $1 a point, you trade for $25 a point below, $25 a point above. That's your risk. Okay, you trade for 50 points or 40 points, you have 40 points as your limits. If you trade for 66 points, one-to-one risk reward approach maximum. Okay, I always use a maximum of one-to-one risk reward approach if I need to. If the price structure forces me to use a one-to-one risk reward approach, I will use it, because I know if the pattern decides to work for me, I will make those 25 bucks, and if I lose, I will lose those 25 bucks. No more than that. Okay, so this is a maximum that I can work with, and usually I always try to minimize that risk into a 1-2 risk reward approach eventually, or something similar. Okay, I can try to play 1-2 risk reward, and eventually sometimes even more friendly situation. That will depend the price structure and the previous highs and lows. But one of it's critical. One of the rules that I created is exactly that. I never enter the market to lose more than what I expect to win. And of course, I'm not talking about small adjustments like I'm targeting 25 points. Okay, I can use a one-to-one risk reward, but I can extend those 5 or 10 points just in case the market decides to nail my one-to-one risk reward. I can try to protect my trade that way, using more 5 or 10 points above that one-to-one risk reward. But even though if you repeat that process and if you lose a consecutive number of trades, that will be very hard to deal and to recover. So stay tuned and pay attention to those specific details when you project a pattern, when you project your entry, when you project your target zones. Do never forget to project also your stops or your limits, where I am wrong, where I will be wrong if the market decides to trade against me. You need to understand that you will not be correct 100% of the times you project a pattern. The pattern will be formed, the pattern will react accordingly, but sometimes the price will form the pattern and will not react accordingly. Sometimes the price will not print the pattern, will stay right there, and it starts to drop, deeper fall without completing the pattern. We don't know what will happen. What we know is after the completion of the pattern, that creates an edge for us. So if the price forms the butterfly pattern, we do expect the 38% Fibonacci retracement as a natural reaction. But sometimes it will fail. So, and for that reason, I always need to put my stops, to put my limits. So that being said, I hope you enjoyed this kind of a presentation. Let's see what let's observe some of those reactions, and I will try to share some other patterns with you during the week. Things to pay attention to, I believe, in my humble opinion, dollar versus yen. Even a drop from this current price zone, it may offer a nice opportunity to go long if the price decides to reject the previous highs again and starts to bounce. So that may offer a nice opportunity to go long. And of course, the metals, specifically gold and silver, I believe there's a good probability for, let's say, for the recovery of the 200 moving average on silver, and because gold already recovered above that 200 moving average. But specifically for silver, I believe there is a lot of room for silver for the long side, long term for the metals. Of course, if you shorted if you shorted crude oil, you should also pay attention to the 74.45, which may converge at some point with the 200 daily moving average, also approaching from below. As some of you already know, I don't trade at all the cryptocurrencies. I have a very long term trade, no leverage with Stellar, which is not so happy. I'm not happy with this one. I have long-term longs for the Stellar, not for specific reasons, just because I saw the chart and I enjoyed the price structure, and I was expecting some big reactions for the upside. Actually, I still believe there's a room for a retest of the highs, but this is the only one that I own as a non-leverage position. A few bucks on Stellar, and expecting, well, let's say if the price decides to go to 6,000, I will become a millionaire from the night today. But that's not what I'm expecting. I'm just playing for fun. Actually, just playing this one for fun, just to say that I'm also I have my wet feet also on the cryptocurrencies market, not because I'm a really big fan, but just because I want to get some involvement, but not the ones that I used to trade. Basically, I'm very focused on the Forex markets, commodities, and eventually some of those index markets. So that being said, I hope you enjoyed this sequence. Don't forget to subscribe my YouTube channel. Don't forget to press that like button in order to get some notifications once I publish some new videos. And of course, if you want to trade some of those patterns, don't forget you can go into www.tradingjazzfx.com, and from there you can subscribe my Telegram channel, where I tend to share some of those patterns. The most recent one, the dollar versus yen, as an example, the crude oil, also the long side for the gold and silver. So if you want to get involved on some of those patterns with a very decent risk-reward approach, subscribe to my Telegram channel, and we will work from there. That's all for today. I hope you enjoy. As always, stay well. A big hug for you. All the best for you and your families and friends. Stay good, and see you the next day ahead.